Good afternoon. This is Howard Coleman again from Coldstream Capital Management. Welcome to our 2015 market update. We will have two portions to this call. The first portion will be a market update given by Darren Ritchie. Darren, as some of you may know, is a portfolio manager at Coldstream. Darren has been in the wealth management investment advisory business for 11 years. He's a portfolio manager. He holds the Chartered Financial Analyst designation as well as the Chartered Alternative Investment Analyst designation. For those of you who know Joe Cervantes, he is the portfolio manager on Joe's team and a member of our Coldstream Investment Strategies group. So let me turn it over to Darren now to give us the market update.
Thanks, Howard. We'd just like to give a quick commentary on where we've been in the first quarter before we move on to the thematic topic of today's call, which is an RX for FX, the implications of a strengthening dollar. So Howard will cover that, but before we move on to the dollar as a theme, I want to give an update on what the markets did in the first quarter of the year. So for those of you who have the chart deck open that we emailed out, please move to the second slide after the title slide. This is a recap of 2015 index returns, and there's a number of different market sectors listed here. The reason we like to illustrate what the markets did last year, or rather in the first quarter of this year, is that I think a lot of us have the maybe unfortunate habit of referring to the market. Was the market up? Was the market down? When in reality, as we see, there are a lot of global markets, and since Coldstream is a global asset allocator, most of our clients have asset exposure to most of these categories. So we think it's important to take a look at what all these classes did. We won't go through each of them in detail, but we'll start here as an orientation. So I think the first thing that jumps out at us as asset managers is a lot of the stuff that worked very well in 2014 is lagging to some extent so far in 2015, and vice versa. So if we start at the top of this chart, you'll see that the large cap U.S. equity indices had a very good year in 2014, up more than 10%. And with one exception, they are fairly close to flat so far in 2015. The S&P 500, although it hit a record high today, most of that gain has come so far in April, and the first quarter was only up about 1% or so. The one exception in terms of large cap performance has the tech industry. Specific sectors of tech have done even better than the NASDAQ composite, but technology continues to be a market leader. As we get into smaller U.S. equities, smaller companies, the mid-cap and the small-cap indices also had decent years in 2014, but they did less well. They did less well than large caps. That has reversed so far this year, and small caps are beginning to outperform in a fairly significant way. Those indices up more than 4%, which we are pleased to see given how they lagged to some extent last year. That said, the big change so far in 2015, it's been really a kind of a sea change in the investment markets, has been the recovery and leadership of international equities. The MSCI EAFE index, that stands for Europe, Asia, and Far East index, measures the performance of developed countries such as France, Germany, Australia, and Japan. That index is up 5% in the first quarter. However, as we'll see in a few minutes, that index is up vastly more than 5% if you owned it as if you were a domestic investor in those countries, the difference being a currency issue that we'll talk about in greater detail. Emerging markets have also started to participate after a weak year last year. They've actually been kind of dead money space for a number of years now. The emerging markets are starting to participate in a positive way, up about 2%. And then as we move into the bond space, kind of discontinuous performance there as well in certain categories. The Barclays Aggregate Bond Index had great performance in 2014 as interest rates fell. Rates have continued to fall this year, so the index is up yet again, but we'll see how that evolves. We think interest rates are probably not going to move sharply upward, but we've also probably seen the recent lows in interest rates. So that index may not go very far so far this year, or for the remainder of this year, rather. Two other categories, international bonds continue to be weak. Again, this is a currency issue that we'll talk about in more detail. High yield bonds, the bonds of riskier issuers, riskier corporations, right on track from where they did last year, and these returns are actually a little bit compressed due to energy exposure that we'll talk about. And then finally, a few alternative categories. Commodities continue to be extremely weak. We've all seen the impact of falling oil prices on gasoline prices and other energy areas. while hedge funds and real estate are notching up decent years. So a quick overview of where we've been so far this year, and then we'll move into a few charts on particular markets. Page 3 is the S&P 500, an index that we all know and track very closely. And as we'll see, behavior here has been a little bit unusual from a seasonality perspective. If you look at the month of November, we had a very strong rally off of the October correction. The market closed near highs at the end of November, and then December was a sideways month. The market dropped, it recovered, and it dropped again coming into 2015 and really went nowhere for December, and that was true as well in January. 2 choppy months with not a lot of direction to them. The net direction for those 2 months was down, which is a little bit unusual. You tend to have what's called the Santa Claus rally, stronger performance near the end of the year as year-end optimism sets in about retail sales and other figures. And then February, we saw a nice recovery, and so far that's been the major gain of the year, whereas March has been another down month and April trending upwards. So a lot of chop in the S&P. One thing that we look at positively is if you take a look at this chart and look at the market lows that have been put in this period, you'll see that the lows are higher every time along this chart. We're putting in a series of higher lows, even though we're not breaking out to the upside. That probably indicates that the market is consolidating. We had, again, a great year last year. So as the market sort of digests those gains through the year in 2015, we expect that we'll come in positive on the S&P. We're probably not going to see double digits again. That would surprise us given what's going on globally, but a mid-single digit return would be very achievable for the S&P 500 for the year. The next chart, as I mentioned, a few market sectors have been very strong, really outperforming the broader indices like the S&P or the Dow Jones. One of those has been biotechnology, and for those of you who are active in the biotechnology field, you probably see this every day. Tremendous amount of optimism in this sector about things like targeted therapies, genetically related medicine, all of that leading to extremely strong performance in the biotechnology index, which is lifting the tech sector generally, and to some extent the broad market indices as pharmaceuticals and other genetic medical companies have done very well. So that's one area where we're seeing real leadership. As I mentioned, another area that's recovering from underperformance last year is the small cap market. This is the following slide. Measures the Russell 2000 index, and we've seen what we call a breakout here. We've clearly eclipsed the highs that we set around the end of 2014. We've broken out of a trading range that we were in for November and December and January, and have seen some performance to the upside. And we're again near all-time highs in the small cap index currently in the first quarter. The next slide relates to what I mentioned in terms of the performance of international stocks. The blue line and the red line represent, in fact, the same market. This is the Euro Stoxx 50 index, which is, I'd say it's comparable to the Dow Jones Industrial Average in the U.S. It's 50 of the biggest blue chip European companies. The difference in this chart between the red line and the blue line is whether you own that as an American, you're investing your dollars in European countries, you're buying euro-denominated companies, or if you own this index as a European, where you're investing your euros in these countries and you don't have any exchange issue. The difference between these two lines is all down to the weakness of the euro versus the US dollar. This makes it challenging for us as allocators because we like European stocks. We think they're cheaper than U.S. stocks right now and they represent a valuation opportunity, but the currency issue is a headwind. And fortunately for us, for many of our client portfolios, we've been able to use some currency hedged vehicles which have given us performance closer to the blue currency neutral line than to the red line at the bottom, which is the dollar-denominated European equity index. To that point on the following slide, to us foreign stocks still look cheap. This chart prepared by my colleague David Powers, who's also a portfolio manager here at Coldstream, a new addition to the firm in the last few months. We're very excited to have David aboard. He prepared this report. It's just a historical ratio of how U.S. stocks have compared to international stocks. So it is just a backward-looking historical index, but it does show that U.S. stocks reached a historically high level of outperformance compared to international stocks coming into 2015. We're touching this gray line near the top of the chart, a full 2 standard deviations above the normal balance between these markets. And as we've seen, whenever the line gets a little bit out of whack, it gets toward the extremes of the chart, we've seen a convergence back toward the mean over the long term. Again, just a backward-looking indicator, but it's something we pay attention to that says that international equities are historically undervalued and may present some good opportunities going forward. One particular market internationally that we have been watching with some interest and concern has been the Chinese equity market, which has been a very tough place to invest for many years. Ever since the financial crisis, China has lagged and has been a difficult place to make money. That has changed rather incredibly in the last 3 or 4 months, where you see this almost vertical line of Chinese market performance. Some of this we think is due to the slowing of the Chinese property market. The residential property market in particular has been a place for many Chinese investors to put their money. As that market has slowed and the government there has signaled that we think you might want to find other things to do with your money, that's been a real clear signal to investors that maybe it's time to buy stocks. And so we've seen a tremendous amount of inflows into the Chinese equity market, some worrisome speculation in terms of use of margin to invest in equities. So while this performance is great, if you're in the market, we are watching very closely to see if it's sustainable or if we're setting ourselves up for a bubble. Moving more to the fixed income side of the markets, interest rates, as I mentioned, trended down in 2014, and they've continued to do so thus far in 2015, although not to a great extent. And our thinking on long-term rates, this is a very difficult part of the market to forecast. I think most investors have expected higher interest rates due to the extraordinary accommodative action of the Federal Reserve and other central banks. That really has not come to fruition, and if anything, we've seen rates trend downward since most of the Fed's extraordinary activities like quantitative easing have been put into place. And even with the end of quantitative easing, when many people expected rates to snap back to a more natural level, they have failed to do so, and they've actually gone lower since quantitative easing ended back in October. So although we don't see a lot of upward pressure on rates now due to weak commodity prices and no signs of inflation in the system, there's also not a lot of impetus for rates to go much lower. So we think we're probably at the status quo on long-term rates for the near to medium term. In high-yield fixed income, this is the issuance from more risky companies where there's a credit risk built into the bond. High yield has done fairly well because America is quite healthy. Even the riskier, more leveraged companies have been able to make their interest and debt payments on time, principal payments on time. The one area that is struggling, not surprisingly, is the energy sector. And this chart simply shows the proportion of the Bank of America Merrill Lynch High Yield Index, the proportion of that index representing the energy sector. And we see that that has increased fairly steadily from 2009 all the way into 2014 as more and more small and mid-sized energy companies, riskier energy companies, floated high-yield bonds to finance their operations. And unfortunately, as commodity prices have collapsed in the last 6 months or 8 months or so, there's real concern about whether these companies that are leveraged and that have budgeted based on oil prices near $100 a barrel in many cases, are they going to be able to make those payments? So the drop that we see in the percentage of that index in the last bar of the chart, that's not due to a reduction. Well, new issuance has stopped, but most of that decrease is due to the price of those bonds falling as a result of concern about whether the companies are going to be able to pay their debt. In terms of commodities themselves, again, a very difficult area to forecast with any accuracy. However, we would note that the following chart shows U.S. oil production compared to the number of oil rigs in operation that are actively exploring for new sources of energy. And we see that rig count, the blue line, has shot up fairly steadily ever since about 2008 when we had a soaring commodity price environment, oil price environment. Rig count has increased steadily until it rolled over dramatically in 2014 as oil prices all of a sudden gave back much of that gain and went back to $40 or $50 a barrel. We think that given the lack of drilling activity, and this rig count actually continues to fall, if supply of energy is not replaced because these new alternative wells tend to expire quicker than old ones, that red line, U.S. crude oil production, is likely to taper off its increase and eventually roll over in the next year or two unless we see a snapback in oil prices that incentivizes people to begin drilling again. So there may be a floor under commodity prices, oil prices in particular, over the next year or so. Following chart, it takes a more long-term view, what we call the cyclical view. This is a couple of indicators that we look at in terms of should we be worried about the overall economy? Is this time to batten down the hatches and get defensive given how strongly equities have performed over the last few years? Should we be taking profits at this stage, or are we okay to continue for the time being? The blue line that you'll see here is a difference between 10-year interest rates and 1-year interest rates as measured by Treasury bonds. And what we notice is whenever that blue line goes negative, a recession tends to follow within 1 to 2 years. And a negative blue line means an inverted yield curve, for those of you that are familiar with the term. It means that short-term interest rates are higher than long-term interest rates. Historically, that's abnormal, but it has been a nearly bulletproof signal of a recession coming. And so the red line, which is GDP, dips into negative territory after the blue line does. And we see today that although the yield curve is flattened slightly, the blue line has ticked down a little bit. We are still definitely in positive territory. Real GDP growth continues, not at a blistering pace, but at a fairly steady, acceptable pace for us. And so we don't see any signs of recession in the near term. We don't see any signals that it's time to get terribly defensive. So with that, that's our first quarter market update. I'm going to turn the call back over to Howard Coleman for a dollar presentation.
Thanks, Darren. As those of you who have attended this call previously know, we try to take a topical subject each quarter and delve a little deeper into that. And this quarter, we wanted to talk about the dollar. It is one of the more significant niche issues going on in the world right now economically. We all know that the dollar has strengthened significantly over the past few months, although recently it has been more range-bound against the euro and the yen. In the last 4, 5, 6 months, it has risen quickly. I want to touch on 3 issues relating to the dollar. Number 1, I want to talk a little bit about why it has strengthened so significantly. Number 2, I want to talk about the economic implications of its strengthening. And number 3, I want to give some guideposts looking forward so you can follow along at home as these economic indicators come out as to whether that will mean continued strengthening or weakening for the dollar. So first, let's turn to the chart that says dollar index. And there's 2 points I want to make on this chart. The first is the recent significant rise in the dollar, and you can see it's been a fairly straight vertical line until very recently. But the second point I want to make is that historically, we're really in the mid-range even without this increase. What this dollar index is the value of the dollar against a basket of foreign currencies, not any single currency, but a basket of foreign currencies, and it's weighted to those currencies that the U.S. has the largest trade with. So it's trade weighted. The index starts right around the time, this chart starts right around the time the euro came into effect, which was January 1999 is when the euro came into being. And as you can see, the potential for significant additional strengthening based on where the dollar has been historically is there. So although it has risen rapidly, there is more to go. Or maybe not more to go, but there's the potential for more to go. What is important, however, and why it has had such a large impact isn't the absolute value of where it is now, but it's the rate of change. It's that steep slope at the end that has risen so quickly. And that is what's caused the implication, not necessarily the absolute level. So why? Why does the dollar rise? And there's several factors that go into it. But one of the key factors is comparison of interest rates. And the second chart is global. What I have here is the global yield curve. And this shows interest rates. The red line is U.S. Treasuries. The green line is the euro. And the green line is the yen. And the blue line is the euro. You're so used to historically seeing the yen being the lowest line, but amazingly now it isn't. And if you look at the yield curve, so the left-hand side is the short end, 1 month, 2-year, 4-year, 8-year, all the way out to 30 years in the U.S. Japan and Europe have longer dated bonds than the 30-year. But you can see that U.S. interest rates are much higher. And just as a side note, look at European rates up to 8 years. They're actually negative. you have to pay money to own bonds 4, 6, and 8 years out in Europe. It's historically an anomaly. Well, what do interest rates have to do with the dollar? Well, and the strength in the yield curve. If you own a dollar and you invest that dollar in U.S. Treasuries, because that's the currency of Treasuries is the dollar, obviously, you can earn what by historical standards is a meager interest rate, but look at the 10-year. You can earn close to 2%. If you had that same amount in yen or euro, you're earning less than 50 basis points. So any investor is going to say, well, I'm better off taking my euro, converting it into dollars, and investing in U.S. debt than I am investing in euro debt. It's an encouragement for the banks and other sovereign wealth funds and large pension funds who need to earn a small amount of interest, but a steady amount of interest, and needs to own some sovereign debt. To exchange their currency for the dollar and invest in a higher interest rate. And that exchange creates demand for the dollar, which drives up prices for the dollar. Now, more creative investors, such as hedge funds and others, will actually just go out and borrow euros and borrow yen for virtually no money, take that and convert it into dollars. And then you're making far more than the actual interest rate. And that is a phenomenon that's called the carry trade. You may have heard of that in the Wall Street Journal talks about it on occasion, and other financial publications do. But that carry trade, when large investors do that, have a significant impact on the dollar. And what impact does it have? Let's look at the next one. It says Europe loves U.S. Treasuries, but it's also Japanese yen. The right-hand chart is what I want you to look at. And this is not even with the carry trade. This is just if I had a euro, converted that into dollars, and invested in Treasuries, I made 36.7% because I made not only the interest on the Treasuries, but the value of the dollar appreciation. If I had yen and converted those to dollars and invested in Treasuries, once I convert them back to yen, I own 23%. And so these are phenomenal returns on minimal interest rates that foreign investors can make based on the disparity in the strengthening dollar. And it becomes in many ways a self-fulfilling prophecy or, quote, a bubble, because people want to do it to earn that interest rate. And we saw that really a couple weeks ago when the world was very long the dollar. The futures market was very heavily long the dollar. Now, currently, that has come off a little bit as the dollar has traded in a range-bound fashion, but still, it's a very, very popular trade. The other factor that goes into the strengthening of the dollar is what are the central banks doing? And the dollar strengthening really was tied initially to when the European Central Bank announced quantitative easing. And although quantitative easing didn't happen that moment, the market expectation was it was going to happen. And what happens in quantitative easing is the government buys debt and puts more money into the marketplace. And the concept is when more money is in the marketplace, that creates more supply, which lessens demand. And the U.S. is thought to be beginning to tightening. In other words, the Fed is going to take money out of circulation. They've stopped quantitative easing, and their thoughts are that they're going to raise rates at some point. So the U.S. is acting in the exact opposite fashion as Japan and Europe, which are flooding money into the system while the U.S. is stopping that to some extent. And that creates a supply-demand disparity, and if there's a lot more euros and yen floating around, just by basic economics 101, that's going to decrease their value. So that is the other thing that's going on. The final thing is GDP growth expectations, because the strength of the economy and the ongoing nature of the economy has something to do with whether your currency is viewed as strong or not. And in part because growth creates price pressure, and price pressure in some ways creates increased currency value. So those three things are extremely key factors in why we've had the dollar strengthening. What has that dollar headwind? Well, that dollar strength ahead creates a headwind. And it creates a headwind for companies who sell in foreign markets. If you are producing in the U.S. and they are buying your goods in foreign markets, it's far more expensive for them to buy your goods, which is why in large part, although Europe and Japan do QE, is because it makes their goods cheaper in foreign markets and encourages people to buy their goods. Does this really have a negative impact, or is this just theoretical? Well, this chart is a couple weeks ago, just as reports were coming out. But we saw 70% of U.S. S&P companies, and S&P companies being the largest, do the most international trade. We've seen 70% of them use the dollar as a reason that their earnings have had a negative, the dollar has been a negative impact on their earnings this quarter, a remarkable percentage. And it has had a headwind. More recently, in fact, this morning, I heard that international companies that do more than 50% of their business overseas had an over 10% hit in revenue. And those that have less than 50% of their business overseas actually had a 10 basis point gain in revenue. So that's the kind of talk we're talking about. And I want to also relate it back to what Darren said previously when he was talking about asset classes, when he said that the S&P has had trouble this year, but small and mid caps have done very well. Well, there can be quite a few reasons for that, but one of the reasons is the dollar, because small and mid caps tend to be domestic companies, not selling overseas. So they are not nearly as impacted by this as the large international companies are. Does exchange rates matter? Is there data for it? Absolutely. Here is the next chart where it says exchange rate matters. This is S&P sales growth versus the U.S. dollar. And the dollar is inverted. So the right-hand scale, is inverted. But what you can see clearly is as the dollar strengthens, sales growth in the S&P decreases. The final thing that occurs with a strengthening dollar that's negative is a very tricky one for the Fed. And that is, think about this. When our dollar is strong, we're forced to buy foreign goods more cheaply. When we buy foreign goods more cheaply, if we paid $1 for it last year and we're paying for it this year, that actually encourages deflation. And so if we look at this chart, strong dollar imports deflation, and we see import prices declining, that has the potential to reduce inflation rates in the U.S. And the Fed has made it clear that they've got a 2% target for inflation. And you've heard the Fed express concern about the strong dollar. And it is commonly interpreted as, well, it impacts corporate profits and the Fed is concerned about the stock market. That may be true, but I think this is the bigger concern. The concern is what impact the strong dollar will have on inflation. So that's the second point that we've covered is, why has the dollar strengthened? The third point I want to talk about is what our expectations are going forward. And I have to say that the financial graveyard is littered with currency experts who tried to predict the value of the dollar going forward. But in general terms, let me first talk about what you can look for to anticipate whether the dollar will strengthen or weaken. As I mentioned before, the announcement of European QE was a large factor in the strength of the U.S. in the strength of the U.S. dollar strengthening. If Europe continues QE at a more rapid pace, or if Japan announces additional QE, I think you could expect the dollar to strengthen further. if the Fed raises rates more quickly than the markets expect, and right now the markets are expecting sometime between September at the earliest and the end of the year, if somehow the Fed raised rates in June, I think you would see the dollar appreciate significantly. And in addition, it responds to hawkish pronouncements. So if you see hawkish pronouncements in the Fed, you'll probably see that occur again. Now, European growth is an interesting conundrum because on its own, European growth should spur the euro and should create a stronger euro and a weaker dollar. The wild card in that is if European growth is so strong that the ECB says we're going to eliminate European quantitative easing, you'll see a dramatic reversal in the dollar. So I would say a mild strengthening in the European economy would weaken the dollar, but if it's a strong strengthening and they pull out of QE, the dollar may be strengthening significantly. On the flip side, a dovish Fed, U.S. growth stalling would result, I think, in a weakening dollar. And then, as I said, if European expands but not enough to eliminate QE, that would also result in a strengthening euro and a weakening dollar. Our thought is if the market is pricing in a September hike, if there is a September hike, and if certainty remains the same absent some large event, I think we will continue to see gradual appreciation of the dollar. There's a lot of ifs and buts, and as the Fed so often says, and people get frustrated with it, but it's true. Just like the Fed raising interest rates, what will happen to the dollar is very data dependent going forward. And those are some of the insights that we see as the data that you should look for in trying to evaluate whether it will strengthen or not. So this will conclude our first quarter call. Thank you all for participating. We really appreciate it. And feel free to email your relationship manager or portfolio manager with any follow-up questions you have. Thank you very much, and we'll talk next quarter.